Hey everyone, and welcome back to Econ Aside. Today, we're going to do something really interesting. We're going to take the pulse of India's absolutely massive banking sector.
All right, to really kick things off, let's just start with a number. A huge number. We're talking about a banking sector with loans worth over $2 trillion US. Now, to put that into perspective for you, that's about half of the entire country's GDP. I mean, when a sector is that big, its health, that's everyone's business.
So, that naturally brings us to the big question for today's explainer. Just how healthy is this financial backbone? Is it strong? Is it stable? Or are there maybe some hidden cracks we should be worried about?
Okay, so here's how we're going to tackle this. First, we'll get familiar with the two main tools that the pros use to check a bank's pulse. Then, we're diving into the data on bad loans and these things called capital buffers. After that, we'll give you the overall health report. And we'll wrap up with a really fascinating comparison, a tale of two very different kinds of banks.
Right, so how do you even begin to check the health of an entire banking system? Well, the good news is you don't need a bunch of super complex formulas. The experts, they really just zero in on two key metrics. And these two things, they tell us pretty much everything we need to know.
Let's jump into the first one, and honestly, this is the big one. It all boils down to the quality of a bank's loans. More specifically, we're talking about its portfolio of bad loans, or what are officially called non-performing assets. You'll hear the term NPAs a lot.
So what exactly is an NPA? Well, the definition is actually pretty straightforward. It's any loan where the person or company who borrowed the money has stopped paying it back for 90 days or more. Yep, just 3 months of missed payments, and boom, that loan gets reclassified from a healthy asset to a non-performing one.
Let's make this super relatable. Think about a regular home loan, right? You get a loan to buy a house, and you agree to pay a monthly installment, an EMI. Now, if for whatever reason you miss 1 month's payment, and then a second, and then a third month in a row, that's it. Your loan officially becomes an NPA on the bank's books. It's really that simple.
Okay, now here's a really important little detail you need to know. The difference between gross and net NPAs. Gross NPA, that's the total raw number of all the bad loans. But banks aren't just sitting there hoping for the best. They're smart. They set aside a pile of cash, a safety net really, called provisions to cover these potential losses. So when you take the gross NPAs and subtract that safety net, you get the net NPA. And that's the number that gives you the true picture of how much risk the bank is actually on the hook for.
And wow, look at this. This chart just perfectly captures the incredible turnaround story in India. If you rewind to 2018, the gross NPA ratio was at a really worrying 11.5%. That meant over a tenth of all loans were going bad. Not great. But fast forward to September 2024, and that number has just plummeted to 2.5%, a 13-year low. I mean, that is a night and day difference.
So what does this all mean in context? Well, with a gross NPA of 2.5% and a net NPA of just 0.57%, India's banking sector is now comfortably inside the healthy benchmarks. The rule of thumb is generally less than 3% for gross and less than 1% for net. But let's get some global perspective. Major economies like the US, Canada, and the UK, their gross NPA ratios are all under 1.5%. So things are definitely good, but there's still a little bit of room to get even better.
All right, on to our second key metric. This is going to build out the rest of the picture. See, it's not just about how many bad loans you have, it's also about how ready banks are to actually absorb those losses. And that's where we look at their financial safety cushion, their capital buffers.
So this safety cushion is measured by something called the capital to risk-weighted assets ratio, or CRA ratio. I know, it's a bit of a mouthful, but the idea behind it is pretty simple. Think about it. Not all loans are equally risky, right? A loan to a big, stable company is way safer than a loan to a brand new startup. The CRA ratio accounts for that. It basically forces banks to hold more capital, more of their own money against their riskier loans. It's all about making sure they have enough skin in the game to survive a financial storm.
And when you look at the numbers for India, the story is one of real strength. The Reserve Bank of India, the country's central bank, says banks have to have a minimum CRA ratio of 9%. But look at this. The Indian banking sector as a whole is averaging 16.8%. That is a very comfortable buffer. It's almost double what's required. That's a huge sign of stability.
Okay, let's pull this all together. We've looked at our two key health indicators. Bad loans, they're at a multi-year low. Capital buffers, they're robust and way above the minimum. So,
It's time to put it all together and deliver the final verdict on the health of India's banking sector.
And you know what? The conclusion is actually really clear. Based on all the data we have right now, the verdict is in: India's banking sector is, all in all, in pretty good shape. The numbers we've just walked through, they really back that up.
So just to hammer it home, here's the quick summary of our health report. Gross NPAs? Check. They're below that 3% healthy line. The even more important net NPAs? Double check. Way below the 1% line. And that CRA ratio, that critical safety buffer? Check. It's sitting way above the official mandate. Check, check, and check.
But hold on, the story isn't over just yet. A healthy sector is one thing, but it raises another question. Who's driving this? And this is where things get really interesting. Let's look at this fascinating little rivalry between the big government-run banks and their private sector competitors.
Okay, so if you just look at pure size, ranking banks by their total assets, which is basically how much money they've loaned out, the government-owned State Bank of India, SBI, is an absolute giant. It's number one by a long shot. The biggest private bank, HDFC, has about half the assets of SBI. And ICICI, another private bank, has about a quarter. So by size, the public sector wins.
But now, watch what happens when we stop looking at size and start looking at value, what investors think these banks are actually worth. This table shows their market capitalization, and the whole picture just flips on its head. The private HDFC Bank is suddenly number one, the most valuable bank in India. ICICI Bank is number two. And the giant SBI? It's all the way down in third place.
And this isn't just a fluke. In fact, 4 out of the top 5 most valuable banks in the entire country are private. It really feels like the market is trying to tell us something, right? It's like a big vote of confidence from investors, suggesting they believe these private banks are just better at making money and running a tighter ship. So what are we to make of all this? If the smart money, the market, is consistently betting on private banks to win, does that mean the government should maybe take the hint and just get out of the banking business altogether? It's a multi-trillion-dollar question, and the answer will absolutely shape the future of India's economy. And that leaves us with one heck of a final thought to chew on.